Welcome to The Explainer. Today, we are breaking down a corporate evolution that literally redefined modern entertainment. We're going to look at how a seemingly simple DVD by mail service ruthlessly cannibalized its own success to become a $200 billion global streaming giant.
You know, to really get Netflix, we've got to start with what's arguably the ultimate business paradox, destroying what currently works to build what's next. Going from a quaint little startup mailing out red envelopes to a $200 billion digital behemoth? Well, that didn't happen by playing it safe or just riding the wave of their early success. It took a terrifying focus on the future, a total willingness to shed their old identity, and a radical operational shift that left their legacy competitors completely in the dust.
All right, here's our roadmap for today. We're going to cover cannibalizing the DVD era, the Netflix strategic flywheel, owning the content studio, surviving the cash burn, future risks to streaming, and we'll wrap it all up with the MBA Leadership Playbook. Let's jump right in.
Part 1. Cannibalizing the DVD era. Disrupting the disruptor.
So, the core philosophy here is a bit brutal, but it's absolutely crucial. Cannibalize your own product before a competitor does. We've all heard the classic story of how Netflix took down Blockbuster, right? But their true strategic genius wasn't just beating some slow-moving brick-and-mortar giant. It was their absolute willingness to kill off their own highly successful, super profitable DVD business to bet the entire house on streaming video. I mean, imagine telling your board you want to actively destroy your main source of revenue. It's the ultimate innovator's dilemma. Most companies just cling to their cash cows until a nimble startup comes along and eats their lunch. Netflix, though, they recognized the internet was the inevitable future. Sacrificing the DVD business wasn't just a pivot, it was a preemptive strike against their own obsolescence. And honestly, it was the necessary first step to building a global empire.
Moving on to Part 2, the Netflix strategic flywheel, the data engine. Now, this is their operational secret sauce, the Netflix flywheel. A lot of people think of Netflix as just a tech company, but fundamentally they are a subscription-driven, data-obsessed content studio. And it operates on this brilliant, self-sustaining loop. Step 1, acquire subscribers. Step 2, those subscribers generate massive amounts of viewing data. And we're not just talking basic demographics here. We're talking completion rates, pause rates, and exactly which thumbnail makes you click. Step 3, all that deep behavioral data feeds a highly proprietary recommendation engine, which takes us straight to Step 4, serving you exactly what you want to watch. This hyper-personalization boosts engagement, kills churn, and keeps you happily paying month after month. Finally, Step 5, that predictable recurring revenue lets management confidently reinvest billions back into content, which attracts, yep, you guessed it, more subscribers. It's a cyclical data engine that acts as a massive competitive moat, because every single new user makes the algorithm just a little bit smarter for everyone else.
So how's this engine actually making money? Well, the model relies almost entirely on tiered subscriptions, basic, standard, and premium, which make up over 99% of their revenue. But there's a tiny 1% sliver that's really interesting. That's the new ad-supported tier. For years, executive leadership swore up and down they would never ever run ads. So why the pivot? Because strategically, a lower-priced tier expands their total addressable market to viewers who are highly price-sensitive. And even more importantly, it unlocks a brand new stream of incremental ad revenue without alienating their super profitable premium base. They're optimizing their pricing power, basically tweaking the flywheel to capture absolutely every possible demographic around the globe.
All right, Part 3, owning the content studio, from renter to owner. Think back a bit. For a long time, Netflix was perfectly happy just renting comfortable licensed hits from other networks. Think about everyone binge-watching The Office or Friends on repeat. It was cheap, easy engagement, and it really fueled their early subscriber growth. But renting your foundation? That is inherently risky. Netflix leadership astutely realized that eventually, traditional studios were going to wake up, see the value of streaming, and pull all those prized shows back to launch their own competing services. So to eliminate that massive long-term licensing risk, Netflix pulled off a breathtaking pivot. They transitioned from licensing hits to producing their own global, localized, original IP. We're talking massive, culturally defining hits like Squid Game out of South Korea or Lupin from France. They went from being a vulnerable renter, totally at the mercy of legacy Hollywood studios, to a massive owner of intellectual property, building a fortress library that nobody could ever take away from them.
And by actually owning that IP, they can fully unleash their ultimate weapon, the binge release model. Releasing all the episodes of a season simultaneously isn't just about viewer convenience. It's a calculated, mathematical strategy to drive rapid, viral engagement and absolutely maximize those data network effects. When a highly anticipated show drops, millions watch it at once. Everyone talks about it on social media at once, and it completely dominates the global cultural conversation for a highly concentrated window. This creates a production velocity and a cultural moat that rivals even legacy giants like Disney or Warner Bros. Simply can't easily replicate, mostly because they're often still tied to traditional, drawn-out weekly release schedules. Netflix owns the IP, and they forcefully dictate the exact terms of modern engagement.
Which brings us to part 4, surviving the cash burn, the path to profitability. Transforming into a global content studio certainly wasn't free. In fact, it required an era of massive, contrarian financial bets that absolutely terrified Wall Street. $17 billion. To build this massive, owned library of original content practically from scratch, Netflix had to endure years of staggering negative free cash flow. They took on heavy debt, including billions in junk bonds, just to self-fund over $17 billion in annual content spending. The industry was constantly questioning the strategy, wondering when this massive debt bubble was going to pop. Analysts argued, you can't just buy your way into being a Hollywood studio. But Netflix leadership stayed incredibly focused. They completely tuned out the noise. They knew that content requires massive upfront capital, but once it's owned and placed right into that flywheel, it pays off continuously over the lifetime of a growing subscriber base. They just trusted the math. But here's the kicker. This terrifying cash burn actually worked. They survived the agonizing transition phase. Today, Netflix has successfully transitioned to sustainable, reliable profitability, and they're now boasting operating margins consistently above 20%. For any business leaders tuning into this explainer, this is the ultimate financial takeaway. Short-term pain, when backed by a powerful, data-driven subscription model and unwavering executive conviction, can yield immense long-term profitability. They spent the billions to dig the moat, and now they're comfortably sitting back and collecting the toll.
Part 5. Future risks to streaming. The war isn't over.
Because despite this triumphant financial transition, the landscape is shifting fast, and they still face some pretty massive hurdles. Netflix is far from invincible. Today, they're battling on multiple fronts, all at once. First up, severe domestic market saturation in the US and Canada. Almost every household that wants an account already has one, which means domestic growth is totally stalling out. To squeeze out more revenue from this mature market, they've had to meticulously manage the tricky cultural fallout of cracking down on password sharing, forcing all those freeloaders to finally pay up. At the same time, they're navigating intense labor cost inflation from the recent historic industry writer and actor strikes, which permanently raised the cost of production. And globally? Well, while they're adding millions of subscribers, they're fighting to grow average revenue per user, or ARPU, in highly populated but lower ARPU regions like Asia and Latin America. The flywheel is absolutely still spinning, but the friction pushing against it is increasing every single quarter.
Finally, Part 6, the MBA Leadership Playbook, Lessons from a $200 billion Giant. Let's distill all of this incredible history into actionable lessons you can apply to your own business strategies today. Here is the ultimate playbook for strategic self-disruption. First, cannibalize your successful models immediately. Never wait for a competitor to do it for you. Seriously, if you don't disrupt yourself, someone else will. Second, use robust behavioral data for portfolio management. Don't just rely on executive gut feelings to pick your winners and losers. Third, ruthlessly prioritize subscriber lifetime value over immediate, short-term profit margins. Fourth, localize your content aggressively to win diverse global markets, but strictly centralize your underlying tech and data infrastructure so you maintain massive operational efficiency. And finally, never ever let a licensed asset or a third-party supplier become irreplaceable to your core product. You've got to fundamentally control your own destiny.
To wrap up this explainer, I want to leave you with a final provocative thought. Think about your own career or the company you work for right now. If your current business model was incredibly successful today, generating massive profits, completely dominating the market, would you be willing to actively cannibalize it to secure your future tomorrow? It's arguably the hardest, most counterintuitive decision any leader can make. But as Netflix has decisively proven, destroying your own success might just be the only true way to build a $200 billion empire. Thank you so much for joining me to explore this incredible business evolution. Keep questioning the status quo, and I'll see you in the next explainer.